Picture this. You've been riding high on the waves of skyrocketing prices. Gold had been climbing like it was trying to touch the stars. Silver was shining brighter than a disco ball at a 70s party, and Bitcoin was holding its own as the digital darling of the investment world. But then, bam. In what felt like the blink of an eye, everything came crashing down. Gold tumbled by 12%. Silver took an even wilder dive with a 33% plunge. And Bitcoin, not wanting to miss out on the fun, slipped by 10%. It left traders everywhere checking their screens twice, wondering if this was some kind of cosmic joke. But why on earth did all these supposedly safe and exciting assets take a nosedive together? When you unpack it step by step, the logic behind the chaos starts to surface. We're witnessing a massive shift in global liquidity, and if you know where to look, you might even spot a silver lining in the middle of this sell-off. The big trigger that set off this chain reaction was the news of President Trump's nomination for the next Fed chair, Kevin Warsh. A former Fed governor known for his hawkish stance, Warsh is likely to keep interest rates higher and pump the brakes on the easy money policies that markets have been feasting on. This announcement acted like a plot twist in a thriller, easing fears about the Fed losing its independence. But it also sent the US dollar spiking. And when the dollar climbs, dollar-denominated assets like gold, silver, and even Bitcoin suddenly become more expensive and less appealing for global buyers. It's kind of like when your favorite restaurant hikes its prices overnight and you start thinking twice about that extra side of fries. But wait, it wasn't just the Fed news acting alone. A perfect storm was brewing. Profit-taking played a starring role after these assets had been on an absolute tear throughout 2025 and early 2026. Gold and silver rallied as central banks hoarded them like squirrels preparing for winter, while Bitcoin stayed strong because of massive institutional adoption. But that hype led to overcrowded trades. Too many people piled in at the top, and when sentiment shifted, everyone rushed for the exits at once. This created a cascade of sell-offs that turned a simple dip into a freefall. Add in the leverage factor. Think of it as borrowing money to bet big. It's a high-stakes game common in both metals and crypto. But when prices turn, you get massive liquidations. Reports show around $2.6 billion were wiped out in crypto alone on that day, with margin calls hitting the precious metals markets just as hard. It turned a mild correction into the financial equivalent of a bad haircut, unexpected and a little embarrassing. But hey, hair grows back and so do markets. By the way, if you want to stay ahead of these market shifts without the stress, hit that subscribe button and join the community. Your likes help me keep this channel running so we can navigate these waves together. Now think of these three assets like characters in a buddy comedy. Gold is the wise old grandpa of the group. He's been through every economic storm in history and remains the ultimate hedge against inflation and uncertainty. But even grandpa can trip when the ground starts to shake. On January 31st, that's exactly what happened. As the US dollar surged, gold lost its luster, and investors who had been riding a record-breaking run decided it was finally time to pocket their profits and head for the exit. Then there's silver, the flashy sidekick. With industrial uses in everything from solar panels to high-end electronics, it's always more volatile than gold. Think of silver as the friend who parties too hard and crashes even harder. On its worst day since 1980, silver dropped a whopping 36%. It was triggered by the same dollar spike and a massive unwind of speculative positions that had pushed prices up nearly 250% over the past year. And Bitcoin? Bitcoin is the rebellious teenager in this trio. Often called digital gold for its scarcity, it's the cool kid that everyone's watching. But it still dipped 8%. Not as bad as the metals, but enough to shake things up. Over $700 million in liquidations hit the market as leveraged traders got margin called. It's proof that even the cool kid isn't immune to macro drama, especially when a hawkish Fed signals that the era of easy money is coming to a sharp end. Now you might be thinking, this sounds scary. But what does it mean for a beginner who's just dipped a toe into these assets? Let's shift gears to the lessons we can pull from this mess. Because every market dip is like a bad date. It hurts in the moment, but you learned something valuable for next time. First off, spread your bets. Don't put all your money on one horse, even if that horse looks like shiny gold or high-tech Bitcoin. Usually, people buy gold as an umbrella for when it starts raining on the stock market. But during a major economic storm, something weird happens. It starts pouring everywhere at once. Your umbrella folds, your raincoat leaks, and you're still left standing in the freezing rain. So mix in stocks, bonds, or even cash to spread the risk. That way, you'll always have a dry place to hide, no matter how hard it storms outside. But being caught in the rain is one thing. Being caught with a massive debt is another. That's where leverage comes in. Think of it as borrowing money to bet big. It can supercharge your gains, but it turns losses into total wipeouts faster than you can hit the sell button. If you're just starting out, keep it simple and stick to spot buying. That way, you actually own what you pay for. But even if you avoid the debt trap, the market will still test your nerves. When prices plunge, the urge to panic sell is intense, but that's usually when you're about to miss the rebound. History shows that after big drops, markets have a way of snapping back. We've seen Bitcoin survive much worse, and gold has stood its ground for decades. So, instead of reacting to one bad day, zoom out. The market's best days often follow its worst ones. Speaking of rebounds, let's look at what's next, so you can stop doom scrolling your portfolio. Right now, analysts are as divided as a family at Thanksgiving dinner. The bears are warning of more pain if the Fed stays hawkish, potentially pushing gold down to $4,000. They see silver dropping back toward $50, and Bitcoin testing the $70,000 mark or lower if the liquidations continue. But there's a flip side. Bullish analysts from firms like JP Morgan see this as a massive opportunity. They argue that Bitcoin is now deep in oversold territory and primed for a bounce. Meanwhile, they expect precious metals to find a floor. Between central banks hoarding gold and geopolitical tensions that haven't vanished overnight, the long-term case for these assets remains as strong as ever. The panic might be loud, but the smart money is looking for an entry point. To wrap things up, remember that days like January 31st are just part of the game. They're the plot twists that test your strategy. But with the right mindset, these moments are just masterclasses in disguise. If you're feeling the sting, take a breath and review your plan. History shows that patience pays off far more than panic. So ask yourself, is this a moment to fear or a rare opportunity for the long haul?